Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, April 29th. I'm Jay Gragnani, and joining me is Ian Saunders. And Ian, I don't know what it was, but I got very close to saying August 29th. We're not there yet, although maybe it's the we're getting a nice day here in Richmond, Virginia today, hitting temperatures I think close to 80 degrees. And so, maybe I'm just thinking about summertime and when we're all able to return to the beach again.
Yep, and I've been in quarantine a little too long there, maybe.
That's right. I think this is week 7 for us, having been on quarantine and work from home situation. And, we all continue to operate in a less than ideal capacity nonetheless. Certainly operating in full capacity, and that's the beauty of technology these days that allow us to be able to work from home and continue to do what we need to do while the market is open. And certainly there's not a lack of activity that the market has seen while we've been in the quarantine situation. Really going back, it's hard to believe a couple months ago, February 19th, that the market was at new all-time highs. And, the S&P 500 very quickly corrected down to a roughly 38% drawdown off its peak. And now here we are approaching the end of April, the last few days of April, which, the end of April is one of those times that always reminds me of the old market adage that goes sell in May and go away. And that just kind of speaks to the market seasonality, in that the market tends to provide better returns in what is known as the seasonally strong 6 months in the market, that being the months of starting November through the end of April, historically are the strong periods in the market. And historically, the weak periods in the market, the 6 months, starts at the beginning of May and goes through October. And here, as we're discussing this with the market, the S&P 500 today, as we're doing this, is up about 2.75%, so up about 78 points on the S&P 500. If we go back and we look at this current seasonally, quote unquote, strong period in the market, from the end of October through basically right now, the S&P 500 is down 3%. And that certainly does not tell the whole story. As there's been a lot of volatility in the market. There's been a lot going on. If you look over that time period, there's actually, since then, just looking at broad sectors, only 2 sectors that are in positive territory prior to today, that being technology and healthcare since the end of October, with every other sector being down, with energy and financials being down there at the worst performing sectors, down 37 and 20% respectively. Nonetheless, we'll have more discussion on kind of the market seasonality and the move into the seasonally weak period in the market coming up at the beginning of May. But we certainly didn't want to have a conversation today and not talk about some notable action that we've seen here on the chart of the S&P 500 specifically.
Yeah, and I mean, with that movement that we've seen over this what has historically been the seasonally strong period, down 3% is might be a little surprising given the rest of the movement that we've seen. As you mentioned, there the past 6 months included about a 38% drawdown, at least here at the S&P 500, moving from the all-time high here on the 20-point chart of 3380 down towards that near-term low at 2200. However, we've seen some pretty significant return rally over the past few weeks. Most recently, reversing back up into a column of X's here over the past week and advancing higher over the past few days to give it another buy signal here, return to a buy signal rather, at 2880, and then advance with movement today with the couple percent gain that we're seeing in the broader S&P 500, moving back up to 2940, which is also going to place at least the 20-point chart here back in an overall positive trend. They breaking through this longer term bearish resistance line we saw be set there in the initial decline in March. So definitely a good sign to see this 20-point chart, which has been one of the more followed chart values that we're seeing here. Obviously, a fair amount of different scales that we have here for the S&P 500, the default being the 10-point, but winding it out to the 20-point chart shows you fair amount of that more intermediate term time frame, and it's definitely a good sign to see this follow through, moving things back to an overall positive trend on this particular chart scale.
Yeah, and that movement right there is interesting in the fact that it's moving back into a positive trend, because we talked earlier in the week about one of the indicators that looks at trends amongst individual S&P 500 stocks, and that being the percent of stocks in a positive trend for the S&P 500, or the PT SPX. That indicator has recently moved back to 50%, which simply suggests that 50% of the S&P 500 universe is in a positive trend right now. That 50% mark has historically been an area of importance, in that periods of time where the PT SPX has been above 50% have historically marked good market environments. And intuitively, what that basically means is when you get that indicator above 50%, what it simply suggests is that a majority of S&P 500 stocks are enjoying positive trends on their point and figure charts. When you get readings below that, it simply means that a majority of stocks are fighting their negative trends. And so, after seeing this fall all the way back into the single digits at 8%, which is the first time that we've seen that happen since the 08 time period, this indicator has reversed up and has moved up very meaningfully in the month of April. It reversed up in April and has gone from 14% all the way now up to 50%. I would expect to see that rise. This is prior to Wednesday's market action. So very possible that you could see that close another box up to 52% as a result of today's action. But, certainly in the scope of looking at positive developments amongst the indicators, the positive move back up and potentially above 50% for the PTSPX is a positive sign, and one that we will continue to monitor, as the large cap stocks that make up the S&P 500. Those have by and large been the stocks that have held up a lot better than most. And also the ones that have performed better since the market bottom back on March the 23rd. But this is one of a number of indicators that we've seen here over the course of the past month show some very positive developments, including other indicators like our bullish percent.
Absolutely. And I mean, as you mentioned there, you said that I think you hit the nail on the head with that continued outperformance that we've seen from the large cap equity space. I mean, you can see that reiterated across most of the other indicators we have on the system, whether it be the technical indicators here, or even over on stuff like the asset class group scores page, which, while most of the domestic equity groups have moved quite a bit further south in this market decline, we've seen the large cap areas kind of maintain strength relative to their mid and small cap counterparts. And so unsurprisingly, when you widen out the positive trend charts a little bit, maybe looking at the positive trend for the NYSE. So instead of looking at the positive trend for just the 500 names in the S&P 500, this is looking at the percentage of stocks in the broader New York Stock Exchange, which includes many more kind of mid and many more small cap oriented companies there. The percentage of stocks in that universe that are in a positive trend, while we've seen it advance, moving up from low levels at around 8%, which again, levels we hadn't seen since that 2009 timeframe, has risen up to a chart level of 24% through movement there on Tuesday. So it's still quite a bit below the chart level of, say, the PT-SPX. But we've seen a lot of those small cap names, they're lower market capitalization companies, not show as much follow through to the upside as their large cap counterparts here past few weeks.
Yeah, that's right. This is, certainly one. It's a much bigger universe, but like you mentioned, the universe on the NYSE is going to be more tilted towards small and mid caps, and they haven't participated as much. They, obviously participated much more on the downside. And if you look at you know, in any areas of small cap, you know, small cap value has been amongst the worst hit areas during the market decline, is starting to show over the course of the past, you know, couple of trading days, some rally or near-term strength out of some of those laggard and those weak areas. And here IJS is, you know, fell all the way down to 86 and has recently recovered back up to 118, still in a negative trend, but now to a point where it's testing this downtrend line, going back to that 128 level. 128 is where the trend line on that is. But, you know, certainly well below its high of earlier this year, which was up at 162. And, you know, small cap value stocks, while the S&P 500 in February of this year moved to a new all-time high, the IJS, or small cap value in this case, it was not able to match its high from a couple years prior, from that August of 2018 time period. And so, you know, a small cap value stock still on a year-to-date basis at a loss of about 30%. But, you know, this type of development here over the past couple of days from small cap value, from some of these laggard areas, are having a positive impact and a positive reaction on a number of indicators, like things like the bullish percent for the New York Stock Exchange, potentially things like the positive trend chart for the New York Stock Exchange. We'll continue to watch that. But the bullish percent chart here, and this is BP NYSE. And so instead of looking at trends, it's just looking at the percent of stocks that are on buy signals within the NYSE. This indicator has, you know, reversed back up as a result of Tuesday's market action, the 28th. And as of today, intraday action has this indicator going up to 70%. And that 70% line is, you know, is one of the lines that we have historically looked at on the upside as being the quote unquote red zone. You know, typically you don't get up there very often. And as a matter of fact, the last time it was there was January of 18, got to 70%, wasn't able to get any higher. Prior to that was July of 2014, got up to 70%, was able to get over that during the 2013 market. But it's been since that 2013 time period where the NYSE bullish percent has actually been above 70%. And it's never been, at least back to 74, it's never been up to 90%. The highest it's ever gotten is 86%, and it's gotten there a couple times. But you have to go back. You have to go back in time into the 2003 time period when you got to 86%. Nonetheless, what, you know, the movement that we've seen in this bullish percent over the course of the past few days has been that of more net new demand coming back into the market, more stocks participating on this rally higher as more and more stocks are moving to buy signals. And so now we're up at 70%. That is, you know, it'll be something to watch. You know, do we continue to see net new demand come in for some of these individual names? If you continue to see kind of this laggard rally from small caps and mid caps that we've seen here over the past couple of sessions, you could very well see this indicator continue to push higher. But the other side is one note of potential caution is watching for reversals down from these levels. 70% and above has, you know, reversals down from those levels have historically been pretty negative signs for the market, you know, at least on a more intermediate term basis. And so that's something to watch for. You know, getting up here in and of itself certainly isn't a bad thing. It speaks to the breadth and the participation that the market has seen, but doesn't mean that, you know, we throw all caution to the wind, and then we'll continue to monitor individual positions as we always have.
Mm-hmm, certainly. And some of those individual positions there that have led to a lot of this recent outperformance, at least over the past few days here, is a little bit surprisingly been areas such as energy. I mean, we saw energy names in the beginning first part of this year with that initial market decline actually begin their decline a little bit before most of the broader equity space. You can see on the default chart page of the Energy Select Sector Spider Fund, XLE, the fund reversed down after giving a buy signal in December of last year at 62, reversed down in January, bumped right up against its longer term bearish resistance line and moved quite a bit further south, falling significantly there with the rest of the broader equity decline when that came in there later in March, ultimately falling to low levels from that 62 point down to 30 or 23 rather on that default chart there in March of this year. Since that time, though, this fund has rallied quite significantly, reversing back up to recently give its 5th consecutive buy signal with trading yesterday at 36, and then continuing its advance today all the way up to at least an intraday high here of 38.50. Speaking to that maybe surprising kind of near-term improvement with a lot of these energy names on the backs of the broader crude oil uncertainty that we've seen over the past couple of weeks, with crude oil future prices moving negative for the first time there last week, and then showing some significant rebound over the past couple of days, with crude oil up in excess of 20% here, I believe, with intraday trading on Wednesday, leading to some of these energy spaces showing that continued movement back to the upside. But as you can see here, I mean, while this name's on a buy signal, still does sit quite a bit away from that longer term negative trend line. Current chart levels there at 38.50. The trend line's not going to be had until up at 46.50. But creeping back into normalized trading levels, sitting around normalized trading levels now, and we'll see how this space can continue to play out the rest of the time period here as we move towards the month of May. I mean, these names have not only been pretty well hashed across the space. Looking at some of the larger cap names in and of themselves, like Chevron, ticker CVX, has seen some pretty similar near-term improvement off of its respective bottom down at 52 to recently advance to break a buy signal at 88, moving back to a positive trend for the moving back to a positive trend there for the first time in quite a while. That trend line had moved south in October of last year, and then the fund fell off significantly with the rest of the broader market. So seeing some of the larger cap names like Chevron here with ticker their CVX moving back up into a positive trend could be at least shows the potential there for some of the other names within the energy space to follow suit, taking these buy signals and moving back up above their respective resistance lines themselves.
Yeah, and Chevron, I mean, that stock in and of itself, along with Exxon, are very meaningful pieces to the equation when you look at XLE. Each of those stocks accounts for about 23% of XLE. So combined, those two stocks, Chevron and Exxon, account for 46% of the movement within XLE. And so that's, if you're one way, if you're looking at either one of those stocks, or wanting to gain exposure to energy, buying XLE is going to give you a big chunk of Exxon and Chevron, but then it also a basket of other energy names spread out across the other almost 50% or a little bit more than 50% of the portfolio. But with that said, yeah, you're right. I mean, we talked about small caps having been a laggard area for a while now, and that's not really a new thing, has begun to show some signs of life here recently, not to the extent that we've seen any notable relative strength improvement, but within energy, it's been interesting. Obviously, an explosive move off the bottom has created an environment now that energy as a sector has begun to move into some sector rotation models that we have on our website, as well as begun to move up the ranks within the Dolly sector rankings right now. And so when you look at the Dolly sector rankings down for domestic equities, energy, which had perpetually been in the bottom of the barrel, down in the bottom, has now moved up to the number 6 position within the U.S. sector rankings. So, that's been a recent development here just over the course of the week, that energy has moved up into that number 6 position. Technology, healthcare continue to be the two dominant sectors out there from a leadership position, but energy now has been one of the most improved areas in terms of the number of relative strength buy signals that it has picked up.
Certainly there. And we've seen some of the rotation within the domestic equity sector perspective lead to some further advancement from a relative strength perspective for the broader domestic equity space. I mean, here looking at the broader asset class rank in the Dolly tool, we had domestic equities fall, obviously, from the number 1 position with the market decline down to the number 4 position where it sits here currently. But it fell to a buy signal low of 159 signals back there in March, and has since started to, over the past few weeks here, has regained many of those signals to sit at its current buy signal tally count of 184, which is just 5 signals shy of the number 3rd ranked asset class in currencies. They're at 189, at least through trading there on Tuesday. So haven't seen the asset class change there yet, but definitely one thing to take note of. Even though the broader ranking in and of itself hasn't changed, we have seen some of those signals underneath the hood show at least some near-term improvement for the domestic equity space.
That's right, and what has certainly led that, again, the market has been really narrow this year, with basically the large cap and large cap growth area of the market being the only bright spot. And as you see that participation in the market broaden out a bit, you will certainly begin to see, and that's indicative on indicator charts, things like the bullish percents that we talked about. But as you see the market broaden out and see the small cap areas and even mid cap areas, equal weighted areas, begin to participate in a more meaningful way, then that's when you can see some more signals come from some of those domestic equity buckets. So it'll be interesting to watch, and that'll be something to continue to monitor. If domestic equities is that able to move up into the number 3 position and overtake currency, but also on the top end where you have cash and fixed income, they're only separated by 2 signals, and so it's very possible that you could see fixed income overtake the cash asset class. And fixed income right now, I mean, when you look at fixed income over the course here of the past month, really, you've seen the leadership trends within fixed income change too, to the extent that you've seen some of the more risk-on areas of the fixed income market do well, things like preferreds, things like convertibles, high yield, and corporates. Those are kind of the 3 top areas within the fixed income bucket now. Certainly things that tend to be more risk on as it relates to fixed income, and also things that tend to be less sensitive or less correlated to interest rate movements. Interest rates obviously at historic lows, and who knows if they just stay down here for a while, or if they end up moving up at some point in some meaningful way. If they do move up in some meaningful way, obviously that will negatively impact things like long-term U.S. Treasuries, just because they're so negatively correlated there. And things like preferreds, convertibles, high yield stuff tends to have a little bit more higher correlation to equities and less so to bonds. So just an interesting observation. And so those of you that are running Dolly-based strategies and using rotation within the fixed income sleeve in some capacity, while the U.S. equities asset class in and of itself hasn't moved up, there has been some increase in the risk profile or the beta, just specifically within the fixed income, by seeing some of those other fixed income areas move up. So that'll be an interesting thing to watch, and see if fixed income is able to move up into that number 1 spot and overtake cash. So something to continue to watch. But what you can do also on the system is set alerts. And you can set an alert up there on the top right of the Dolly page to have the system send you an email if those things may change, if asset classes change ranks, if sectors within the asset classes change. You have the ability to go in there and set those alerts, and the system will send you an email to notify you of that. So with that said, also, Ian, the end of April, while we mentioned the start of the seasonally weak period coming up here this Friday, It's also an important update for a number of models that we have on our site next week. And those of you that are following FSM models that are seasonally adjusted, those will get reviewed at the beginning of next week for any potential changes. So if you're following or using any FSM models in your allocation, be sure to look at those coming up next week. Also, you can set alerts on those to have the system send you an email too.
Certainly, yeah. Those models are going to be coming out there. I mean, with the typical seasonal quarter evaluation, most of the monthly models are going to be pushed towards that seasonal quarter evaluation as well. So they'll be evaluated following the market close there on Monday. Trades will be coming out there on Cinco de Mayo, that Tuesday. For anyone that has alerts set on the models, you should see those trades will be coming out there next Tuesday.
Perfect. Well, certainly not a lack of things going on in the market. Hope everybody is staying safe and healthy out there. Look forward to a return at some point to normalcy, not only in our lives, but in the market as well. So with that, in the meantime, we will continue to endeavor to keep you up to speed in terms of any indicator changes and changes within leadership trends in the market. But we absolutely appreciate you joining us this week for the call. If there's anything we can do, please don't hesitate to reach out to us. In the meantime, stay safe, and we will talk to you soon. Thank you.